So in this last chapter for part 1 of the course, which is again basically largely the introduction to all of what we kind of consider kind of like setting up the stage for us getting more into managerial econ. The reason why I then placed these chapters out of order is because I wanted to have at least a brief overview of how firms are then organized, because that proves useful for then understanding the role of the managers within those firms. So since this is kind of now the first material that's relatively new for everyone, just so that you get my sense of how I'm going to be lecturing here then from the rest of these 7 chapters that remain, I tend to use what's called a stream of consciousness style of lecturing, which basically means you can certainly be confident I've certainly read the chapter, I know the material, but then also, I mean, I think that part of the value of having an instructor teaching a course is that you get their sense of how they've taken that information, incorporated it with current events, and how they kind of tie everything together. And that's my sense of doing this. So do I think that you could get away with just listening to the lecture? You probably could, but you may need to find that you need to read the chapter to get some of the finer details. And unlike had this been an in-person class, you would have only been responsible for what I say. In this case, what I hold you responsible for is anything that's at least in the printed chapter, and that's just so that I make sure that everyone is well aware of all the information. Okay, so with that said, when we talk about how firms are then organized, I mean, what do firms do? Firms take inputs and they convert them to outputs. It's that conversion process then that's how firms are organized around. And so what we're going to need to talk about here then are how the firms get the inputs, and then the way that we can organize the way in which we manage the conversion of those inputs into the outputs. So let's skip over, well, I mean, I guess you can kind of, we will be looking at chapter 5 very shortly here. It's not necessary to do it before 6. And I actually think 6 provides some useful information in different ways. You know, if you're working ahead and you want to do 3, 4, 5, and then 6, you'd have to be working pretty far ahead, but if that's where you're at, then that's where you're at. But this chapter specifically then is, how do I take in the inputs? How do I make sure that I get that conversion process going? Again, the idea is that, what do firms do? Firms convert inputs to outputs. What we're looking at in this chapter are the ways that the firms get the inputs. And then we're looking at in this chapter how the firms carry out that arrow, that conversion of the inputs to the outputs. That's the 2 things that this chapter is trying to do. So let's talk about then what a cost function in general looks like for most firms. For most firms, their cost function is going to start at a non-zero number. It's going to start at a non-zero number because there are presumably some fixed costs with doing what they do. And then initially, you'll notice that the costs are increasing at a decreasing rate. This may be familiar if you've taken Econ 130, the Principles of Micro course. Sorry, just fixing this here. Why are the costs increasing at a decreasing rate? primarily because the workers are becoming more productive. And then in this era here, they are increasing at an increasing rate. Because presumably the workers are becoming less productive. So, the goal then is trying to maximize your outputs while minimizing your costs. So how do firms get their inputs? Well, they can do them in a few ways. I'm actually going to start from the bottom here and and I'll start at the bottom and then do the top two. The easiest way they can get the inputs is they make them themselves. This would imply that the firm is vertically organized. Examples that we see of this would be, especially back in the 50s and in the 1960s, the auto manufacturers were organized where they owned the part suppliers, right? Like for radios, car seats, all those things. General Motors, Toyota, Honda, they don't actually make those parts. Right? They're coming from an outside firm, an outside auto supplier, which today tends to be located very close to the firm. Right? The one that we hear about a lot right now is, that you may have heard about, is the Takata airbag recall. Well, in that sense, we're being informed that Toyota, Honda got their airbags from a Japanese company called Takata. But back in the day, that wouldn't have been the case. It would have actually been that Honda would have made them. Toyota would have made them. So some firms, the way that they get their inputs is by making them themselves. Not usually, this is not usually the case. And even the auto manufacturers, as you can kind of tell in the story I've told, even the auto manufacturers got out of that kind of way of doing things. Probably used more often are the contracts, especially for the larger firms. Larger firms get their inputs by agreeing to a contract for a certain amount of time. So, for instance, you could look at any number of firms that sign like a 6-year contract for furniture, for instance, for their offices, or you sign a contract with the company to do all the travel for your company, right? And that contract then basically says you're going to buy a certain amount, or you're going to do business with us for a certain amount of time, and that legal documents, that contract is going to dictate how the inputs are acquired. The alternative way would just be the spot market. The spot market is the one where I just go out into the marketplace and I just say, hey, I want to buy this, or hey, I'm trying to sell this, and then someone else comes by and buys it or sells it. And I may know that person, I may not know that person. In a contract, the knowledge of who the buyer is and who the consumer is, of who the seller is and who the buyer is, that's much deeper knowledge. The buyer and the seller know each other very well. They've all jointly signed this legal document. They've done, presumably, they've done their due diligence. In the spot market, right, it's kind of like a Craigslist, not necessarily just Craigslist, but it's a bit more anonymous. It's a bit more on the spot. Hence the term spot market. Okay, so the kind of example here then that we could see here is you could read each of these and it should be pretty obvious which one is which here, right? Here's my legal obligation, my contract market, right where I'm saying I am going to pay a certain price each year for the next 3 years. I'm going to buy a certain amount. I'm going to pay a certain price. The price is going to go up by a certain amount. Buyer and seller know each other very well and have agreed to these terms jointly. This is our spot market. Someone wants to buy some computer chips. They saw someone that's selling them. And then this would be my vertical integration. The company that makes the computers also makes the other thing. Shows you how much I know about computers. I call it the other thing. So there are some costs. There are some costs in the market that differ based on the type of way that we procure our inputs. So the transaction costs are basically what does it cost to get your inputs. So it turns out, right? I mean, you may have been curious. Well, why was it the case that so few firms actually make their own inputs? And the reason why is because the transaction costs are quite high. Because essentially you're running two businesses. You're running a business that makes your inputs, and you're running a business that makes your outputs. For a lot of companies, they're just like, geez, why would I do that? Here's another example, a really good example, actually. So my airline of choice is Delta Airlines. Yeah, I know, mainland company, but they do fly a lot from Hawaii. But what's unique about Delta is that they actually make their own fuel. They make their own fuel. So what they do is they own a refinery outside of Philadelphia. So obviously they can only get the fuels from so far, right? Probably in Hawaii they're not using their own refinery. But at least parts of their inputs are vertically integrated. They're the only airline that does it. And a lot of investors don't buy that airline because they're like, geez, does Delta Airlines even know how to run a oil refinery? I mean, they're learning, but right, I mean, to be vertically integrated is very costly. Or very risky and costly. In a contract type of market, you're going to be spending a lot of time negotiating your price. You're going to be spending a lot of your time hiring the lawyers and enforcing that contract. And you're going to have to look for that supplier as well that you're going to do that contract with. The spot market gets rid of these things, and then you just really spend your time looking for the supplier. Which would be why if you have a firm that just doesn't do a lot of business, you may find that they just use a spot market for everything. If you're a small business, you might not decide to do a contract, and that'd just be because these costs are too large to doing what you do. Now, within these transaction costs, we also have to think that transaction costs are also a little bit more expensive because the knowledge you have of the supplier that you're going to deal with is really specialized knowledge. If you're not going to do business with that seller or with that other buyer, that knowledge has almost no use with another party. So you're going to have to spend a lot of time getting that knowledge, and that knowledge isn't going to do anything else for you for any other negotiations with other suppliers. That's another transaction cost, right? A big, huge opportunity cost to doing what you're doing with your time. And also, we have this, again, this is a relationship-specific exchange. So in this case here, you see these specialized investments within that kind of exchange. What else do we see with these specialized investments? What are other ways in which these specialized investments occur? Well, they can occur if the site that you're dealing with is very specific. If there's site specificity, that would mean then that because I negotiate for one particular, let's say, auto plant, or let's say an airline negotiates for fuel from one specific fuel company, that's not going to do anything for me for other airlines, for other airports, for instance, or even for other airlines. I might have some physical asset specificity. Sorry to keep going on with this airline example. I think just it works here. If I'm operating, there's two kinds of aircraft that are produced predominantly that we fly, Boeings and Airbus. Well, here we're saying if I have a contract for parts from Boeing, that's not going to do anything for my Airbus planes. Also, these specialized investments also can involve dedicated assets, right? Maybe I set up a buying office near the Airbus, right in France, that's near that supplier. And then alternatively, we could have some human capital. I could have types of buyers that are specifically devoted to that kind of thing, to making those kinds of negotiations. So what does that mean for us then? To the extent that there are more specialized investments, it means that your bargaining process is going to be more expensive. There are going to be times when you wish you would have done this kind of investment, but because of all these sunk costs into the activity, you don't. So, right, there is this problem that specialized investments involve a lot of sunk costs. And these specialized investments as well have the problem then that you get some involvement of opportunism where some firms decide to kind of delay doing an investment until the appropriate time. But now we get to the challenge of the manager then. The challenge of the manager is, okay, so with this kind of knowledge known then, the question would be is, okay, what kind of way should I get my inputs? Should I use the spot market, the contract market, or should I just do it myself? The option you choose is really going to depend on what the relationships are. Because what that's going to do is, right, if I'm dealing with lots and lots and lots of suppliers, or if I'm dealing with inputs that change volatile, are quite volatile in prices, that's going to affect how I do things. Oil is a quite volatile commodity. Perhaps it shouldn't be surprising that with a volatile commodity, Delta decided to get rid of some of that volatility by just owning the asset themselves, the oil. It goes in other ways though as well, right? Other airlines, the other thing that airlines use is contracts. They use hedges. And so what they do is they agree to buy a certain amount of fuel for a certain amount of time. Southwest Airlines, for instance, is an airline that has specialized in these kinds of contracts. Turns out, though, right, you can lose from a contract. If you type into Google News right now and you look at fuel hedges for airlines, you'll see that a lot of the airlines have actually lost a lot of money this year because they made long-term contracts betting that oil was going to go up in price, and it turns out that it has not gone up in price dramatically. And so those airlines have lost money. So let's look at each of these kinds of markets. First, let's start out with the spot exchange. In the spot exchange, what we have are obviously no specific relationship-specific investments. That's kind of the highlight of this, is that it's actually a pretty cheap kind of market to get involved in, because you're just kind of like posting on Craigslist, hey, I'm looking for a freelance graphic artist, right? You're not going to know that person necessarily. You haven't invested a lot of time in getting to know who that person is. Not going to have a lot of transaction costs. There's going to be a certain price that you pay for a graphic artist per hour. You're probably going to be charged about that price. Now, the problem with the spot exchange market, though, are, yes, it's cheap, but you're not investing a lot of time to get to know a lot about this market. So you're underinvesting in, right? Maybe you actually need a dedicated graphic artist, or you need to know that you can always call in a graphic artist because you have a contract to deal with them for a certain period of time. You've also got the problem of the opportunism rising again. And you see that opportunism because it may be the case that you're underusing or overusing that input to try to gain on a situation where you actually didn't need to have that kind of input involved. For the contract, what we're seeing here is that we obviously have a great deal of specialized investment. Spending a lot of money hiring lawyers, doing my due diligence, doing background checks, right? You would have whole departments just involved in writing these contracts if it's a very big firm. Now, the reason why you spend all this money is because you're getting rid of the opportunism. You're doing it because you're going to be properly investing in the number of inputs that you need, because you have a guarantee to have access to those inputs. So you're going to use the right amount of inputs to make things. Probably the hardest thing, and this would be now when we go back to why did the airlines lose money on their contracts? Because they didn't get a good optimal length of time for the contract, right? I mean, ideally, they almost shouldn't have guaranteed. Maybe they should have said that oil prices are going to go up at some point during the next 5 years instead of during the next 1 year. Having that longer time period would have given more of a chance for prices to rise. So since the big decision then of the manager with this is, okay, how long do I need to have a contract for? Well, what I have to do is I have to balance it against my benefit and my cost. Where my cost for the contract is having to renegotiate the contract, to check their references again, to renegotiate prices, to renegotiate quantities. I'm obviously getting a constant benefit from having access to those inputs. We're just saying the cost of getting those inputs are changing. But if you can accurately graph what these are, then obviously I'm going to set my marginal benefits to my cost. And what you can see is that if you have a suboptimal length to your contract, then the problem would be is that I didn't invest enough. I didn't invest enough, and I should have had a longer contract. The longer contract will get me that greater investment that I needed. That's part of the trick then to doing business well, is to get the correct length of the contract. And again, this can seem quite daunting. So a lot of firms are just like, geez, why do I even want to do this? And so some airlines just don't even do fuel hedges because they don't exactly. It is risky to specify how long the contract should be. And for a lot of the airlines that have shareholders that look at their quarterly results, they're going to get quite grumpy with airlines that are not giving them the earnings per share that they need. And you could get it wrong by just having the wrong size of the contract. So then maybe you just say, you know what, let's buy my fuel in the spot market. Then I at least don't have to have that kind of investment. Now, you can see that this changes as well depending on the complexity of the contracting environment. In a more complex contracting environment, we might see shorter contracts. If the contracts are not that complex, then you would see that the contract length tends to be longer. So if I'm buying a simple thing like pens, maybe I sign a 10-year contract. But if I'm doing a contract for, trying to think of the one that, and the state, since I work for the state, why don't I just start talking about the state? The state has obviously lots of contracts. For some of them, for instance, for the rail, those are quite complex contracts and they last just a few years. Whereas again, or the one that the contract that they have right now is for prisoners that are being sent to Arizona, right? An incredibly complex contract that you do negotiate quite often because prison incarceration rates do change. But I would imagine there's a contract somewhere the state has made for pens. They didn't make it for this one. I got this one from the Embassy Suites. Call 1-800-EMBASSY for reservations. Yeah, that's your tuition dollar. Hey, you did pay for this. I stayed there on university business and I took their pen. Maybe that's their contract. I would imagine somewhere there's a contract for pens. And it's probably going to be a very long one because the pens aren't that complicated. The other way to do this would be to have vertical integration. And in the vertical integration, again, we're talking about the firm having to producing the inputs themselves. Again, you don't see that often. When will you see it? You'll see it when what you need from the supplier is something that's incredibly highly specialized. So then maybe you say, okay, maybe we should do it ourselves. Or you don't want others to have that kind of knowledge, right? This would be the reason why Delta did it, primarily because the contracts can be quite complex, and the way in which oil prices change can be quite uncertain. There's obvious advantages to doing things this way. And I should have said too, there are significant transaction costs because you essentially own another business then. The advantage of it is primarily that you are your own supplier, so you can't really unfairly gain from yourself. So you're not going to have any opportunism. There's not going to be any transaction costs because the transaction costs are going to be incredibly low. All that you're doing there is you are just calling up another division of your firm and having more inputs brought over. You have to do all those negotiations. The disadvantage is that you're going to have to set up this other business. You're going to have to take all the risks of having that other business. You're going to have to, and you're going to become distracted. You're no longer going to be specialized in making your output. Now you're an input and an output maker. And that's an incredibly complex kind of business to be into. You don't see, as an, trying to think of what is the best example of a highly integrated, highly vertically integrated firm. The example used to be General Electric, GE. But then after the 2008 crisis, a lot of CEOs, what CEOs do is if they're coming into a vertically integrated company, they tend to get rid of that vertical integration in order to boost the share price, because then you're selling spin-off businesses. DuPont used to also be a quite vertically integrated business, but the CEO came in and got rid of parts of it. And the CEO is the reason why they're selling it is because hedge funds and other venture capitalists are coming in and saying you need to, or activist investors are coming in and saying you need to boost the share price. So here's our trade-off then. This is the decision tree for the manager. A very useful slide for your life after university. What kind of contracts, what kind of input is this that I'm getting? Is it going to have to require specialized knowledge, investment in this relationship? If it doesn't, just go out on the spot market. If it does, then you need to start to think about, okay, am I going to do it as a contract or am I going to do it myself? And here's my decision tree for the manager. Very important slide. Now, that's the first. So what we've done now up to this point is we've now done this. Now we need to look at this part. So this was slides 1 to 18. No, 17, sorry. And this part's going to be 19 to 26. How am I going to compensate those who are creating these contracts? What I need to do here is I need to make sure that the manager, who probably doesn't own shares in the company, and if they're not the owners of the company, the problem is that what comes about is a principal-agent problem. How do I know that the agent, who is the manager, is acting on the best interest of the principal or the owner of the company? Because the agent's getting just a salary, right? The principal, the owner, they want to have a good job done at a very cheap cost. And so what we then need to do is we need to make sure then that the manager has an incentive to do right by the owner. How do you see this? You tend to see this sometimes with the notion of commissions and bonuses. My wife works for, my wife is in finance and she works for a big firm on the, she lives here in Hawaii obviously, but she works for a firm that's located in the mainland. And as a person in finance, right, we need to make sure then that she's acting in a way that maximizes the return on assets for the firm as a whole. The only way that that can be done is by saying, hey, you're going to be paid as a fraction of the share of business you do, or bonuses that add up actually to almost as much as the pay is, or more. So there might be a small amount of pay involved, but most of it is based on how hard are you working? How hard are you making sure that the owners of the firm are getting properly compensated? There's my principal agent problem. So now the owners need to create a incentive structure to make sure that the managers do what they're supposed to be doing. Something bad happens. Why is that something bad happening? Is it because the manager is doing something wrong, or is it just something that's uncontrolled for? So I need to create a structure that controls for both of those kinds of things. So what are managers thinking about typically, right? Is that managers have that trade-off between wanting to rest and wanting to work. And obviously they want to rest as much as possible, but some want to work very hard. The problem with a fixed salary is that employees then don't have they're just counting down the hours to get out of work as fast as possible. Whereas, in this kind of thing, my wife has other friends that work for other finance firms that get a fixed salary, and those are people that work 8 to 5, right? They count down the hours, they get their 3 weeks vacation, right, 2 weeks vacation, and they're done, right? They get a low amount of pay, but they have a pretty easy schedule, pretty fixed salary. The other way that it works, right, would be with the incentive contract where, my wife might work 50, 60 hours a week. Why would she want to work that much and have less leisure? I know, someone's making a joke right now of like, spend less time with you, Scheiding. That's may in fact be true given the fact that I like things like managerial economics. But no, I don't think so. I think that probably a bigger part of the reason, right, is you get paid a lot. You get paid a lot to work more. And so then you will work more, right? You'll work longer hours because you know that you're going to be compensated for it. Why would you work more hours if you were getting a salary, right? And you're getting the same pay if you did not think you'd get a payoff? So there are whole organizations then that are involved in creating a structure for helping firms design their incentive structures for their employees. Tech firms, for instance, use stock options, right? They make them part owners. In the case of my wife, and as is done in a lot of the finance firms, the profits of the firm are tied to the bonuses. Basically, I'm trying to find ways to make workers feel like owners or act like owners so that the owners benefit from it. Now, what I could do as well, if I don't have that kind of an internal incentive structure, I could have an external incentive structure. And I could just say, hey, we are about to merge with another company. I'm only going to need one type of this kind of manager, right? There's you and the other manager at the other firm that's coming with us, that we're merging with. Who's going to be the good one, right? My managers then are going to work harder than the compensation may reflect in the immediate moment, because they're worried about losing their job in the future, right? Or some managers might work hard because they want to build a good reputation so that they can move up within the firm, become an owner someday. It's not only the case that there's a principal agent problem between the manager and the owner, there's also a principal agent problem between the manager and the worker. The manager oversees workers. The manager needs to make sure that the workers are properly incentivized to work hard. Okay, so maybe I give them small little bonuses, or maybe I find ways for them to feel like an owner, give them shares of ownership. So Walmart, for instance, helps employee, right? They advertise in the employee workroom. I've seen the employee workroom at Walmart. I do not work there. But in the break room, there's a daily rundown of what the share price is, the stock share price. And what the firm does is they encourage employees to buy shares, right? So then these workers are going to work very hard because they're going to say, hey, my part, right? I actually am a part owner in this firm. I'm going to work hard for this firm that I partly own. What else could we do? Well, could let them share in some of the revenue. Probably I can see that at Walmart, but you might see that at some other smaller firms, family types of firms. I could pay people, instead of a salary, I could pay them per job they do. And then I could also have time clocks to make sure that they're working a certain amount of time. And I could have quality checks on the work that they're doing. Okay. So when we put that all together, then what we get from this chapter is we get an idea of how do I manage my transaction costs in getting the inputs, and then how do I manage the work of my managers and the work of my workers by creating a proper incentive structure to get around this principal agent problem. Okay.